Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Lori Graymont. And Lori is the president and CEO and chief bottle washer of Summit Assets Group. And she's been working in real estate, I guess, for about 25 years. She started when she was 2. Lori started out by helping her mom and dad rehab having properties. And she's really good with a drill and a hammer, I hear. And she says, when she got married, her husband said that she had nicer power tools than he did. Anyway, Summit Assets Group helps connect investors with real estate investment opportunities. And Lori is also the president of the San Jose Real Estate Investors Association, or SJREI. And that organization provides education and networking opportunities for real estate investors. It's a place where people come to kick tires and try to find out a little bit about what this is all about. So Lori, thank you so much for joining me today.
Michael, thank you.
Today, Lori and I are going to be talking about real estate investment alternatives. Lori has been slammed recently, and so we haven't really had time for doing extensive preparation related to some of our other activities. So we're going to sort of talk a little bit about what's going on in the market, how it's changing, to sort of squeeze more into our program here today. Lori, why should people be thinking about real estate investment alternatives now?
Well, people should be thinking about real estate as an alternative investment always.
Okay.
Whether the market is going up or the market is going down, there's always an opportunity or a play, an opportunity to make money in the marketplace.
Mm-hmm.
The thing is, people like to live in houses.
Uh-huh.
They much prefer it over tents.
Yes.
And if you think of what happened during the 2008 to 2012 timeframe, there was not a lot of building.
Mm-hmm.
And so we've pretty much consumed the inventory that's out there in most of the marketplaces. So it's tight. So now there is an opportunity to get in, buy investment properties, hold them as the market continues to appreciate.
Right. And the other thing that we've seen, again, in that time frame is home ownership as a percentage has gone down.
It has.
And so, well, if you're a landlord, I mean, that means more opportunities for you. But anyway, I mean, there are definite shifts that are happening, out there.
Well, before the 2008 timeframe, there was an artificial floor put under the home ownership. It was like the government was trying to help everybody become a homeowner. And the reality is not everybody can afford to be a homeowner. Mm-hmm. So it inflated those numbers, and now we're coming back down towards, well, we're a little bit lower than the average of where it has been in the past. But I think people are afraid to be homeowners, which is a great opportunity to be a landlord, because it means you go in, you buy it. And there's also a different generation. The younger kids aren't rushing off to be homeowners like we did when we were like get out of high school, get out of college, and buy a house. They don't want to do that.
Yeah, but you felt like you could buy a house in those days. Now, especially if you're here in Silicon Valley where we are, I mean, I guess a nice starter home is about $750,000 to $800,000.
Exactly.
That's a big nut to crack for a kid that's just trying to, get their feet on the ground.
Yeah.
And a lot of them have had a hard time just getting their careers going.
That's right.
It's been a slow start. So, frankly, they're not even renting. They're staying with mom and dad.
Well, and we are seeing a change into a multi-generational household.
Yeah.
So it does mean that there are more opportunities to have rentals because there's more of a rental population.
Yeah, yeah.
Mm-hmm.
Okay. Another thing is the idea of just diversification, of course.
Of course.
So we wouldn't tell people you don't not to have securities because they're liquid. You can sell them tomorrow. A house takes a little more time, although some of the more, if you're in Atherton or some of these other places, not so much. But anyway, yeah, it feels like a liquid investment. But anyway, if you're going for the best deal, though, you need to be able to wait a little bit.
Well, and you do need to be diversified. I mean, you shouldn't be all weighted in real estate either. But in the same sense, you shouldn't be all in the stock market.
Right.
I mean, if you won $1 million lottery, would you rush to throw it all in the stock market immediately? Hopefully not. Hopefully you'll diversify it and put some there, some into some real estate, and some into liquid assets.
Well, I wouldn't do it by picking and choosing stocks, but anyway, yeah. We don't want to have all the eggs in one basket,
That's right.
one way or the other. It's a good idea to be diversified. Even under modern portfolio theory, they say you want to have different asset classes because they tend to move a little differently, and then that way you're going to get a little more stability as far as your returns.
That's right.
Okay. Well, let's talk a little bit about some of the different alternatives, and then move a little bit from there.
Okay.
So first of all, let's talk about advantages and disadvantages of owning rental properties.
Okay. So rental property, for the most part, is a safe investment because it's a long-term investment. You're looking at it long-term.
Mm-hmm.
But as with anything, an investment has the opportunity to go down while it's, in your time of holding it. So a lot of times I'll tell people when they're looking at the rental property, make sure that you've got adequate cash on the side before you make a purchase, because there's going to be expenses. Maybe your tenant doesn't pay for a couple months and you have to evict them. But in the long run, you should see a good return of anywhere from 10 to 12% cash on that property. In addition, the tenant is making your mortgage payment. So after your 30 years, your house is paid off because for the most part, your tenant has made that for you.
Right. So because of that cash flow, people we were talking about, they're saying they can't afford to own a home. Well, they can't afford to own a home to live in.
Right.
But if they're getting rent from the property that's helping to pay the expenses, then in fact they could own a home that otherwise they couldn't afford.
Michael, live where you want, but own investment property where it makes sense. So it's okay to go and invest outside the state of California, and it's amazing. All the houses there have got roofs and doors and bedrooms and kitchens and everything just like we have here.
Yeah.
And you know what? You can buy a house for under $100,000. So for less than a down payment in California, you can own the entire house. And you could probably get 2 or 3 with some financing. And for a $100,000 house, you should get at least $1,000 a month rent, if not better. In most of the marketplaces that are out there, such as Dallas or Atlanta, Birmingham, you can get a little bit more.
Yeah. So what about residential versus commercial? I think you focus more in the residential area, partly because of hammering with mom and dad when you were a kid, and that's what you're familiar with.
Yeah.
So.
Yeah, residential is more familiar just because we've all mostly lived in residential housing. So residential can be a house, single family, multifamily. Commercial also is sometimes called multifamily, but it's also your retail center and warehouse and that. If you're not familiar with it, don't go into it. It's definitely a higher risk without the education. Now, the returns on your commercial could be better because it's more stable. You're not dealing with the toilets of a tenant calling you on Sunday night. You have typically businesses, and as long as the businesses are doing well, they pay well, and they stay for a long time. Tenancies like 7 to 10 years. And so it can be a good place, but it's definitely not a starting point. I don't think that anybody who's just getting started in investing should jump into commercial first shot.
Okay. So there are different ways, of course, that you can invest in these properties. So one that we were talking about is the idea of buying and flipping a property. We see, the television, flip this house, and, wholesaling and so forth. Maybe you can comment a little bit about getting into that.
So I love watching these shows, even with the experienced investors on the show, they show how they go in and they say, oh, it's going to be $30,000 to renovate this house. And then $90,000 later, they're putting it on the market,
it's
right?
It's the Winchester Mystery House, right?
Always. If I could say anything to anybody who's thinking that that's where they want to start, don't. Because if you've never fixed and flipped a property, you will most definitely lose money on your first one because you don't understand the difference between fixing for resale versus fixing the way you like it. We instinctually look at the house as though it was our home, and we want to fix it to that level, but that's not what you do when you do a fix and flip. And so unless you have a coach with you, a mentor, or somebody walking you through, don't start with fix and flip, because just like on the shows, your rehab will end up being about 3 times what you think it is.
That's kind of scary, isn't it?
It is. But if you have a coach or a mentor or a partner that has done it, there's great opportunities, especially here in the Bay Area where you're buying a house, let's say for $550,000, it's a 1960s original, everything.
Yeah.
You can spend $150,000 renovating that and maybe turn around and sell it for $850,000 to $900,000 pretty easily in this marketplace. But you have to know how to use that money to get the best dollar exchange on that.
Yeah. So you doing it was a little bit like when we were remodeling my kitchen.
Yes.
And we had this person come in that does this sort of thing, and he says, okay, I want to lower the ceiling, I want to do this, that, and the other thing, and the tab is going to, and this was several years ago, be like $50,000 or so. And I said, we bought the house for $100,000.
Yes.
And so I went to somebody else, and he said, we can get some decent cabinets, that you'll like. That have the roller things and so forth at Home Depot and so forth, and and do a nice job here, and it'll be $30,000.
Right.
I said, okay, that sounds more like,
Yeah.
because it was more like cleaning up instead of trying to, okay, I'm going to tear out the walls and
Right.
start over again.
But that $30,000 probably grew a little bit, didn't it?
It maybe a little bit, but not a whole lot.
Well, that's
we
good.
we did pretty well.
Yeah, so when I first started rehabbing, I called my mom up because, of course, I did most of it under her when I was younger.
Yes.
And so I was doing it on my own, and I called her up and I said, Mom, how do I know how much to budget for when I'm rehabbing to make sure I make a profit? And she said, well, you go out and you call 3 contractors and you get 3 bids and you add them together. And then she was silent. And I, of course, I'm waiting for her to say average them,
Yeah.
and
that's what it's going to be.
just add 3 of them together. And if you do that, you'll have enough profit.
That's interesting.
I thought that was like the best advice I could have ever had. So that's my advice to anybody who's going to do fix and flip.
Now, what about buy and flip? So there you're not really even trying to fix it up.
Yeah, so wholesaling, there's a couple of different terms out there. Wholesaling, and you might hear wholetailing.
Okay.
Wholesaling is where you put a property under contract, but you don't have the money to close it. You don't close it in your name. Instead, you take that contract and you assign the right to buy it to somebody else. And you just take the money in between. Now, wholetailing is where you actually close on the property, and you go in and you maybe sweep it up and you take care of the lawn, pull out some carpet, make it look presentable. And you can sell it almost at a retail price, which is why it's wholetailing, because you're not doing a full renovation.
Right.
You're simply making it presentable. An example of this is we bought a house in Willow Glen area, and it was owned by a hoarder, and it took like 14 flea bombs to go off.
Oh my gosh.
And we simply went in, cleaned out all the stuff that was on the inside, set off the flea bombs, and then were able to put it out to a buyer that was going to fix it, add on, etc. So that's a wholesale. We had to buy it in our name and then just do minimal work to put it back out.
Okay. But there's a lot less risk for that than trying to do the fix and flip type.
There is. You have to know your numbers well enough. You have to know what the retail buyer is looking for in order to do that and buy, at the right price.
Yeah.
The least amount of risk is the wholesaling, where you put it in contract and you get somebody else to perform on your contract before your due diligence period is up. That way, if they don't perform, you can cancel before your due diligence is up.
So when you're doing that sort of thing, you really need to sort of learn your marketplace. You need to learn who the players are.
You need to learn your neighborhood.
Yeah.
People say, well, how's the San Jose market? It's not a San Jose market. It is a neighborhood by neighborhood market. And you need to be the expert in your neighborhood. And once you do, then you know what you can pay for pricing.
Right. But I was just thinking, like SJREI, there's a lot of people there that are looking for opportunities.
Yes.
And so for a wholesaler, that's a good type of, because they're looking basically for somebody to put a deal in front of them.
Yes.
Okay, here's a property that you can work with if you want to do a fix.
Exactly.
and so on. So that's a great networking opportunity for that type of thing.
You know, if you're an investor or want to be a real estate investor, you must be connected with other investors. It
Yeah.
is not something that you want to do as the Lone Ranger. There's this is such a large investment, especially here in the Bay Area.
Yes.
You know, usually it's the largest investment that any individual will make in their entire life, let
Right.
alone, you know, whether it's for their own personal residence or as an opportunity.
Yes.
And you would never just hand that money over to somebody else that way. So why wouldn't you surround yourself with experts?
Yes.
Of course. I mean, that makes sense. So join a club, whether it's SJREI or other ones that are local. Be part of an expert community where you can get help, advice, and take it. You know, yeah. Don't let the ego get in the way. You know.
So don't think you can just sit and read the book. You know, make $1 million in real estate
Yes.
in 50 days or less.
Yes.
And think that you can just go out there and do it. You know,
Exactly.
You really need some support.
And pay for education. There is nothing wrong for paying for the education. It's actually better to pay for the education, because if you don't, you will pay for your education.
You're going to pay a lot more.
Plus the time that you lose in that.
Okay. Let's talk a little bit about real estate partnerships. So this
Yes.
is another way that people could invest.
Yeah. So let's say that you have some extra time, but you maybe don't have all the money that you need to do a fix and flip or to do a real estate investment. You can go out and partner with people. You know, it's one way to do real estate is partnering with someone with what you're missing. You know, the typical things that you have to do a deal would be money, credit, time, knowledge. If you don't have all of those, find the person that does and you partner with them into a deal.
Yeah, or you may be the person that has the money.
Yes.
And so, you can plug into somebody that has the expertise, and maybe you give them, you know, more of the action, but then they're taking on that operation and management that, you know, you just don't really have those skills.
Yes.
So why not let somebody do it? It's going to reduce your risk considerably.
Exactly.
And again, there are people that do, I know, that do this fix and flip type of a thing, but it's not quick flip.
No.
So they're doing 5-year turnarounds.
Yes.
They buy apartment complexes and so forth. They're going to do a beautiful job renovating them, getting them rented up, upgrading the tenants and so forth. And then they can turn around for a nice markup like clockwork.
That's right.
And so why not plug into something like that? Because frankly, you may have other things to do that you're better at.
That's
right.
right.
You know, if you're an attorney, go be an attorney. That's fine.
That's right.
And then, you know, and you're making some nice money, why not invest it, you know, in a real estate partnership?
That's right. And you mentioned something there, Michael, that I think is really critical. Here in the Bay Area, people don't know how to wait. They want that instant bang. You know, it's like, oh, I have a house and it should be going up $10,000 a month or $30,000 a month. And so the thought of investing their money for 5 years, they're like, oh, that's too long. But the reality is if you can invest your money and double it or even almost double it in 5 years, why wouldn't you? I mean, why would you take the risk? Because if your return is higher, your risk is more.
Yes.
So take it slow and steady. You know, be the turtle in the race. And take it slow and steady.
Yeah. I mean, if you get that kind of return, that's actually a great return.
Exactly.
I mean, you know, certainly better than you can do in most cases in the stock market. Okay, if you get lucky with it.
Yeah.
But, you know, I mean, the thing is with real estate, you can take some of the luck out by having skill and knowledge.
That's right.
And so if you're buying a property right, you're doing the right things with the property, your risk is going to be considerably less. And your likelihood of coming out and making some money at the tail end are a lot better.
That's right.
So anyway, okay. How about private lending?
Yeah, so private lending, I always say, is for the individual that wants to invest in real estate without owning the real estate. So you become the bank for somebody. You know, like we have a lot of private lenders that we work with at Summit Assets Group. And our lenders will lend us the money to make purchase and acquisition repairs. Some of them will do long-term loans where we sell to an investor who wants a 50% down and they'll pay off the 50% in 5 years. And so we have people who use their IRA funds. and they're in that 5-year note receiving a 10% return on their money into their IRA secured at a 50% down payment on a piece of property. I mean, that's more secure than any bank was out there with their 100% financing.
And what do you get from a bank?
Yeah.
1%? Less
yeah,
than that.
Yeah, so, it's great for retirement funds. It's great for people who don't need to live on the income right now and can build their nest egg. And it's slow and steady, but it's good returns. I mean, 10%.
Yeah. Well, that's why, and we talk about IRAs, so that when you actually invest in the real estate with an IRA, there are actually risks that are involved. Things can go wrong.
Yes.
And the whole thing can get disqualified. This note is much more straightforward, and you can even, in some cases, have an equity participation built
Yes.
into the note. And so it's all interest.
Yes.
It's, a tax-deferred income in an IRA and a Roth tax-free income.
I know, huh?
Wow. So cool. Okay, how about note brokering and so forth?
So this is something that I think we're going to see a lot more of in the next few years. Everybody kept saying, where's the inventory? The inventory is going to come down like this big flood from all the defaulted notes, all the foreclosures. But as we know, it never came down. And now if there's any investors in the Bay Area looking for inventory, there's very little. There's almost none. The reason is that the banks were essentially told, don't foreclose. They had their hands slapped in 2010 with lawsuits. And so they didn't foreclose. And they were just holding these defaulted assets on their books doing nothing. And all the little municipalities were saying, hey, we're not getting our tax money. The lawns are overgrown. We need something to happen here because you're ruining our communities. And so the government and the banks agreed that they would sell off these non-performing loans to investment firms such as hedge funds and the like. And that started happening in January this year. So we're going to start seeing the transfer of these non-performing notes to the hedge funds. Now what the hedge funds will do is they'll pick what they want. And then what they'll take those notes that they don't want, they'll sell them down to the next investor. And so we're going to start to see people saying, hey, I want one of those notes. Why would you want a non-performing note? Well, let's say you buy a $100,000 house, the note for that at $30,000. Now you go to the person who still lives there and say, why don't I reperform your note? How about you start paying me a monthly payment less than what you were going to pay the other bank, and we'll let you perform. Well, then they start to get income on that $30,000, and maybe they get it for $80,000 instead of the $100,000, but that's still more than what they did. So that whole note paper is something that people can broker. It's something they can make money on, saying, here, find this one, here's a seller, here's a buyer. You have to understand, though, that it is a licensed activity. And if you're going to broker notes, you do need to be licensed in the state of California. So don't just go out and start doing it. You have to be licensed.
Yeah, I looked at it. I am licensed, but
you don't have to be licensed to buy them, though. That's the thing, is you don't have to be licensed to buy them.
Yeah, that's right.
And so it's a great opportunity. It's just like the private lending with your IRA or your retirement funding. You can buy things like that in those vehicles.
Yeah, so there can be opportunities. And again, this is a reason for being involved in groups, again, like SJRER, because then there's networking that's going on. So people are saying, I have people. I mean, I have a person here that has one of these notes in his IRA, and frankly, he wants to get some cash in there. Because he wants to take some distributions.
Okay.
And so,
so he wants to sell his note.
So he wants to sell his note.
Well, send it to me. I have buyers.
See, well, that's what I mean. So there are opportunities like that as well. You're not necessarily dealing with the banks,
right,
or somebody else, because sometimes maybe it may not be the best terms and the other things.
Yeah, and let me make this clear. You and I aren't going to call up Bank of America and say, hey, I want to buy your non-performing. They're selling them in the trillions. They're selling packages in the trillions and billions. Okay, so we're not a player to the bank. But there are opportunities for us to buy them from the smaller hedge funds that take the chunks down. So.
Okay, so another thing that we talked about before had to do with the repossessed property. So I take it that has sort of cooled
Yes.
In the last few years.
Yeah, pretty much since 2010, the banks have been slowing down their foreclosure and taking back the REOs. They're working to get short sales. They're working to get modifications out there to slow down, the whole turnover in neighborhoods. Yeah.
Yeah. Okay. So we've got a whole 5 minutes left, and we have something really you could probably make a whole interview about, and that's due diligence. So why don't you talk, though, just for a couple of minutes about due diligence. What is it, and why is it important for real estate investors, and what are some things to think about?
Wow.
Yeah, I know.
I only have 5 minutes, huh?
Well, like I said, just
Okay.
try to hit a couple of highlights.
So due diligence means that you are going to research everything you can about a property before you buy it. And there are a lot of things to know about the property. In the state of California, we use title companies or escrow companies that help to do some of that research. So they're going to research the chain of title, which means that when you're buying it, you actually get ownership on that particular property. Now, the reason that's important is that there were a lot of foreclosures that happened in a very short period of time, and it is not uncommon to find a foreclosure on a property that was the wrong address.
Oh, whoops.
Or that something didn't get put right in the legal description, and now you no longer own both parcels that need to go together because the house is sitting on both parcels. So you have a title preliminary report that tells you any mistakes that might have happened. That's the first thing, because you want to know you have clear title, you have clear ownership of that.
Right.
It will also tell you whether there's any back taxes or any liens that you maybe didn't know about. Is there a mechanic's lien because somebody was doing repairs and didn't get paid? These are all things you need to know about the property's ownership. In addition to that, you need to know about the property itself. Get a full property inspection. You should have a termite inspection. You should have a roof inspection. If there's fireplace, you should get a chimney inspection. These are going to tell you what costs as the owner you might incur if you want to repair those items. In addition, you want to know what's going on in the community. For example, if you're buying properties in Oakland and it's a single family, you're under rent control for some things but not for other things. So you need to do your research on what you can do, what you can charge for rent. How do you vacate your tenants? Those kind of things. In other cities, there may not be rent control, but there may be things like the sewer is paid by owner only, and nobody paid the sewer the last 4 years, and that's not on your title report because it's a municipality, it's not a lien.
Yeah.
So you really have to understand what is normal in your community as far as what you should research.
Right. So what do you think of the idea of buying properties off eBay sight unseen? You just look at the picture.
Never look at the picture. Never, ever look at the picture. Okay.
So you need to have somebody really, first of all, if you can go yourself, but otherwise you need to have somebody there to go and actually look and see what it looks like.
Right. You know, I've bought over 1,600 properties nationwide. And I can tell you I did not see them all personally myself. But what I do is I start with the numbers. Then I research the community. I find out if there's value in the property. And if there is, I will hire somebody to go look at the property. I will hire an inspector to go look at the property. I'll hire an appraiser to go give me value before I buy it, because that's what you do for your due diligence.
Thank you so much for coming and being my guest today, sharing some of your knowledge and experience. As we said, I mean, for you, this is your everyday. For most of us, real estate maybe is even a little mysterious. And so it's definitely a good idea to look before you leap.
For sure. And
now you have a website where people can get information?
Yes, so if you want more information on Summit, you can go to www.summitassetsgroup.com. And if you want more information about the Real Estate Club, it's www.sjrei.org.
Okay.
And if you're going to invest, connect with the community.
Great. Thanks again, Lori. Thanks a lot, folks. See you next time on Financial Insider Weekly.